All right. Let's get this going. Here we go. Alrighty, thank you so much for joining me here today. Let's make this a little smaller so I can see you. As you have questions, just let me know. So today we're going to be talking about the student loans. So everything you need to know about student loans. Throughout today's webinar, please chime in, ask me any questions you have. Feel free to speak up or type in the chat. And the topics for today are the different types of student loans, student loan repayment options, deferment, forbearance, and loan forgiveness, and how student loans affect credit. So I wanted to start off with some statistics regarding student loans. So $1.75 trillion in student loan debt exists in the United States, with a total of 43 million borrowers. So it's the most prevalent type of debt for US citizens. 2.6 million borrowers owe $100,000 or more in student loans, which is just an astronomical amount. And the average balance for student loans is just under 40,000. Most consumers take about 20 years to pay off student loan debt, and about 21% of borrowers see the amount of student loan debt increase in their first 5 years of payment. And typically that's because interest accrues while you're in school and it's smacked on that loan balance once you graduate and you enter into repayment. So I wanted to start by going over the main types of student loan that exist. And we'll start by looking at the federal student loan options. So about 70% of college students borrow money to help pay for school-related expenses, and most obtain loans through the federal government. And we're gonna, I'm gonna admit someone here, bear with me. So the first type of student loan is what's known as a direct subsidized loan. So the direct subsidized loan is for families who demonstrate financial need. It's the most common student loan. You don't need to be in a position of financial hardship or anything of that sort. This is essentially a loan that says you don't have the funds available to pay for college in cash. The second type of student loan is direct unsubsidized loans, which is also available to most students. Interest begins accruing at the loan disbursement. So that's really important because that means while that student is in school, they are accruing interest. And then Perkins loans are for exceptional financial need. So those are going to be much harder to qualify for and not the standard. Most loans that you'll see, especially on credit reports, are going to be direct or the subsidized or unsubsidized direct loans. So interest rates and fees are set at the start of each academic year and remain fixed for the life of the loan. So what does that really mean? When you get a student loan, each time you need a pool of money, it creates its own loan or its own term. And then let's say you have a new semester that starts in school and there's a new set of loans that are created for you. Those loans could be at the same rate or a different rate, just depending on if the rates have changed at all. So you may see several different loans on your credit report when you take out those student loans. It's not as if you get one loan that pays for all of your college, which is why a lot of people will end up consolidating their loans once they graduate. Now, private student loans are very different from federal loans. So private student loans are coming from your typical banks, credit unions, private lenders. Most people have heard of SoFi now. SoFi is a pretty popular lender that refinances a lot of student loan debts. With private student loans, they're different from federal in that they do offer fixed or variable interest rates. Federal student loans typically aren't looking at credit score, where a private loan is looking at a credit score, meaning you could get a lower interest rate potentially if you have an exceptional credit score. Most of the time, though, federal student loans tend to have a lower interest rate overall. Private student loans also don't offer as much flexibility when it comes to different payment terms. Those repayment options on the federal side we'll look at here in a couple of slides from now. You also do lose federal protections like forbearance and deferment. So for instance, with COVID, we had the student loan deferment. private student loans did not have the same deferment that federal loans did because of COVID. It would have been up to each financial institution to determine if they wanted to offer any sort of deferment or modification to the student loans because of COVID. So those are private loans. The rest of the time, we're really going to focus on the federal student loans as they are the most common type that we see. So before we get into the loan types, let's talk about deferment and forbearance. So most people don't realize there are so many different options for both deferment and forbearance. The main deferment most people are familiar with is school deferment, which is typically automatic. Once you're enrolled in school, that enrollment information is sent off and that updates your loan status and automatically puts you into deferment. Other deferments you do have to apply for, and you have to submit that request directly to your loan servicer. Interest still accrues during deferment, except as I mentioned, with the exception of the recent COVID deferment, which is ending coming up here on May 1st, 2022. Forbearance is pretty similar to deferment, but it functions slightly differently, where in some cases you may have a reduced payment. A general deferment may be granted for no more than 12 months at a time. And a deferment doesn't necessarily have that restriction of 12 months like a forbearance does. For both forbearances and deferments, you're allowed a total time period in the life of the loan of 3 years of that deferment or forbearance. So once you hit 3 full years, you're out of that benefit that you were eligible for. So on the screen, you'll see a bunch of different deferment and forbearance options. So let's start by looking at deferment. So we have cancer treatment deferment, where this will defer your payments
I
for.
don't see anything. Sorry, I'm interrupting you. I don't
Oh,
see your screen. I see your face.
Oh, it says I'm presenting. Oh my goodness, guys, you know what I did?
You have 2 screens.
Let's try this. You're just letting me talk and talk and talk. Not showing you any of the right things.
There we go. Thank you.
Now? Okay, hold on. Let me go to the screen I was on. You missed all my beautiful slides. Okay. Can you see this now?
Yes, I can see it.
Much better. Okay. Wow. On the left side, we have the deferment options. So you'll see cancer treatment deferment. A lot of people don't realize you can not pay your student loans while you're undergoing cancer treatment and then up to 6 months after you've received treatment. There's economic hardship deferment as well. You do have to submit documentation. There's a separate hardship for unemployment as well. And then you've got active duty and then rehabilitation. So if you're in a rehabilitation program for drug or alcohol abuse, that can also allow you to have your payments temporarily paused. For forbearance, we have some other options like financial difficulties, medical expenses, employment changes. So you can temporarily suspend payments, let's say if you're transitioning to a new position, or let's say with that transition, maybe you're going to a sales role and you're temporarily going to have decreased income. You could get your payments either lowered or paused for a short time frame. And then there are mandatory forbearances. So somebody who has gone to medical school and now they're in a residency program, they're going to have a mandatory forbearance, meaning there's no choice. The servicer must put that forbearance in place for their loan. So any questions at all on deferment or forbearance? Let's move on. So what most people are interested in are the types of repayment plan options for student loans. So the most common repayment types are known as the standard repayment plan and the graduated repayment plan. So standard repayment plan is what you're automatically going to be enrolled in after you graduate. So that enrollment itself, you won't have to start paying. You're deferred after you graduate school for 6 months. And then your standard schedule is a 10-year schedule. So what's going to happen is your payments are fixed, and essentially they take your loan balance and they divide it into that 120 payments plus interest, and your payments are the exact same amount every single month until your balance is paid off at the end of that 10 years. You can pay it off early. There's no early payment penalties or anything of that sort. Your payments are higher under this type of plan because the goal is, of course, to pay it off faster. So it's more of an aggressive payment option. You have the option to do what's called an extended fixed repayment, which is really just where you're, exactly as it sounds, you're extending that term. If you do a consolidation of your loans, you're automatically enrolled in the extended fixed repayment plan. So this chart is showing the differences of what that term would automatically be altered to if you did a consolidation up to that 30-year time frame. So most people fall into the 10-year time frame because, as I had mentioned earlier, once you when you take out student loans, you end up getting several loans for each term or each semester. So most loans tend to fall under this category of 10 years where they're $7,500 or less. So you may have multiple loans at the same time that you're paying on that are all under $7,500 that each have their own separate payments. So the standard plan makes sense if you're trying to limit the total amount you're paying back, right? You want to reduce the interest and just get your loans paid off as quickly as possible. So someone who has a $35,000 student loan balance with a 4% interest rate would have payments of $354 each month and would pay overall with the interest about $42,500, to give you an example with that more aggressive payoff structure. When a standard repayment or a graduated repayment plan doesn't make sense would be if you are someone that will qualify for a loan forgiveness. And we're going to look at the different loan forgiveness options and who qualifies in a couple slides as well. And the graduated repayment is slightly different than the standard repayment. So graduated repayment is where every 2 years your payments increase. So you're still scheduled to pay off your loan at the end of the 10 years, but you just start with a lower amount and it gradually gets bigger and bigger and bigger and bigger. The same as the extended repayment, an extended graduated repayment just takes that time frame and extends it out up to that 30 years if you consolidate your loan balances. So any questions on either of those two primary loan types or repayment plan types? Okay. So when you're determining what plan is correct for you, it's important to consider what your goals are. A lot of times we hear just to pay everything off as quickly as possible, but that's not the only way to repay off debt. So prioritizing, are you trying to have the lowest monthly payments to improve your cash flow? Or are you trying to reduce the amount of interest you're paying? There's not one single correct answer. And really a better way of saying it is the only way to find the correct answer is what works for your particular situation, because each person needs something different. The specifics of your situation, like your income level or your desire to pay off the high interest debt, or your eligibility for loan forgiveness problems, all comes into play when determining what the best decision is for you. And it's also important to factor in, you don't want to pay off your debt too aggressively at the expense of having something like an emergency fund to fall back on. Or, some people also want to invest in retirement or play with money in the stock market, right? Whatever those aspects are in your life, just make sure you prioritize them in your goals. Okay. So next I want to look at the different repayment plan options that not necessarily everyone is eligible for. So the standard and the graduated repayment, anybody can do either of these programs. But when we get to the income-based repayment options, these are going to be specific to who qualifies. So we're going to be looking at income-based repayment and pay-as-you-earn repayment, and then income contingent repayment, excuse me. All of these options are very similar and have very minor differences. So the main similarity is that they're all based on income and then the size of your family and the percentage of your payment versus your income rather than looking at your loan balance and then determining your payment from there. So, all right. And all of these options will require you to submit documentation on an annual basis to prove that you're still eligible as well. So the first one we'll focus on is this income-based repayment. So income-based repayment, again, based on income and family size, instead of how much you owe on your loans, like those prior repayment options. So your payments are 10 to 15% of your discretionary income. And so discretionary income is going to be the amount of income you have as a household or as an individual person. The amount that you have to invest, save, or spend after taxes and necessities, which is going to be things like your mortgages, your rent, utilities, credit card debts, any other monthly obligations after those items are paid. So 10 to 15% of the money that's left. The payments are recalculated each year based on any updates you have when it comes to your income, changes in income or changes to your family size. So if you have a tighter budget and you need to if you need to decrease your monthly expenses, this is a good option. It's also going to be a good option for anyone that may qualify for the public service loan forgiveness, because if your loans are going to be forgiven anyway after a set time, why pay a ton of money into it? Why not let more of it get forgiven at the end? And it doesn't make sense if you're trying to pay off your loan quickly, right? If you're trying to pay the least amount of interest. So perks of this plan that most people are not aware of: any outstanding balance you have on this loan that isn't fully paid off after year 20 or year 25, depending on when you receive the loans. There's set dates on if you open the loan pre-2008 or pre this year, then it's either 20 years or 25 years. But anyway, whatever's left at that time is now forgiven. So you do pay income tax on whatever amount is forgiven, but that's a heck of a lot less than having to pay that full loan off, or what's left of that loan. The next one we'll look at is the pay as you earn repayment. And then they have a revised version of it as well. They're very similar. I'm just going to talk about it in a general sense. Monthly payments are in this case limited to 10% of your discretionary income instead of that 10 to 15% of the prior plan. So unlike many of the income-driven repayment plans, your payment can exceed what it would be under the 10-year standard repayment plan if your income is higher. So someone could do this plan even with higher income. But again, if you have higher income, that could make that plan, the payment amount calculated a bit higher for you if 10% of your discretionary income is high. Your spouse's income and loan debt is also factored into your monthly payment calculation, even if you file your taxes separately. And same with the other plan, the income-based repayment, any balance you have after the 20 to 25 years is also forgiven. Again, you have to pay income tax on it, but can be a huge perk to be in this plan. If you have a high student loan balance, you're looking to get it paid off, and you're not going to be in that mode of people that would pay a higher amount than the standard repayment. Last one, income contingent repayment. So this is based on your income and family size as well, and limited to 20% of your discretionary income. Payments are calculated each year based on updated income and family size, just like the other two plans. And the total amount of your direct loans. So this one does factor in your loan amounts, whereas the other two did not factor in your loan amounts. And similarly, it has that forgiveness option as well. So. Any questions about the different repayment plan options? All right, let's move on. Loan forgiveness. So in terms of loan forgiveness, we hear a lot of different words used or interchanged for loan forgiveness. So we've got forgiveness, cancellation, and discharge. And they mean almost the same thing, but they're used in different ways. So if you're no longer required to make payments on your loans due to your job, for instance. This is generally called forgiveness or cancellation. So we have like the teacher loan forgiveness or public service loan forgiveness as an example for that. Or there's other circumstances like total or permanent disability or school closures where you received, or the school closure from the school that you received the loan from, which is generally called a discharge. So I'm going to go through each of these and when they apply very briefly. But for the public service loan forgiveness, this is the one most people are familiar with. So if you're employed by the government or a nonprofit organization, the remaining balance of your loans after 10 years are forgiven, or 120 payments. Why I say or 120 payments is because anytime you do a forbearance or a deferment, that can pause, that puts a pause. So you have to do at least 120 payments. So you may have your loans active for 12 years because you had 2 years of deferment or forbearance that took place before you were eligible then to get the loan forgiveness. So any sort of deferment or forbearance stops that clock temporarily. So the last however long it's been that we've had in pause for COVID does not factor into that timeline of loan forgiveness for anyone who's eligible under these programs. Okay. Teacher loan forgiveness. So if you teach full-time for 5 complete and consecutive years in specifically a low-income elementary school or educational service agency is what they call it, you can have a forgiveness of up to $17,500 of your student loan. So there is a cap on how much they will forgive. One of the things we do see quite a bit here that we work with our clients on are closed school discharges. So if the school closes while you're enrolled, or sometimes the school may be, this will be more of like a false certification discharge down the list a little bit more. If the school closes, or if the school is no longer considered accredited, things of that sort, something changes, then you may no longer be eligible to pay that loan and your loans may be discharged. You'll see that I think DeVry is the one that I'm thinking of that happened more recently. But you don't just automatically get the forgiveness. It is something you have to apply for and something you have to prove. So it can be pretty cumbersome for borrowers to navigate that path. And we do have resources available. We partner with an organization that can make sure all the documentation is filled out properly so that people who are eligible for these programs actually receive them, because that is one of the biggest issues with these forgiveness, cancellation, and discharge programs is people aren't actually getting the cancellations, forgivenesses, or discharges because they're not filling out the paperwork properly. They don't know how to fill it out. And, you know, unfortunately, the servicers aren't helping people figure that out. Let's see. Oh, another instance can be if your school, like let's say you withdraw from the school and the school was the one funding your loan. They got the money from the government to pay for your classes, and they fail to return that money back to the government. You are not on the hook for that. Again, it's something you have to apply for, but you are not on the hook in that situation. And then parent borrowers, if you are a parent and you become permanently disabled, or the opposite happens, your child does, or there is a death of yourself or the child, that can also allow you to no longer have to pay those student loans. They'll be discharged at that point. In some of these cases, some cases may require you to pay taxes on any discharged amount as income, but that's going to be case by case depending on the situation. So student loans and credit. We touched a little bit on it. I like to think of student loans as having a parent loan and then all these little baby loans, these child loans underneath them. Each of those quote unquote child loans is going to have a trade line on your credit report. So if you were to miss a payment on, let's say you're billed $300 and that's split across 5 student loans, and you miss making that payment for the $300, your credit is now going to be hit once on each of those 5 loans. So it's going to hit your credit pretty heavily. Student loans don't start reporting to the bureaus until 120 days past, or excuse me, 90 days past due. So you do have some time. I have a typo here, so ignore that, 90 days past due. So you do have some time to catch up your payments before they do go past due. If you apply for a deferment after you are past due and they retroactively apply that deferment, meaning let's say we're in April now, right? So let's say we're in April now. You applied for the deferment here in April, but you want it applied all the way back to January, and you're granted that deferment back to January. Your federal student loans, they're not going to erase the late payments that you incurred between January and April. They do not automatically do that. So those late payments will still appear on your credit report. So that's something to keep in mind. If you are encountering a hardship, you do want to make sure you apply immediately for the deferment before you start going past due. So that way that still doesn't report to your credit report. If you have Sallie Mae loans, which are going to be older student loans, they do start reporting to the credit bureaus a bit sooner. They report at 60 days past due. So keep that in mind. And if you are someone who has not paid your student loans for a set amount of time and they go into what's known as default status, which essentially is just saying they're now in a collection account with the federal government, that defaulted status will stay on you'll stay in default until you go through loan rehabilitation. So student loans don't expire at any point. You always owe them. They may fall off your credit report after 7 years, but you'll still owe that debt. And when you do rehabilitate them, what's going to happen on your credit report is it's going to take the bad credit line, and now it's going to show that it's pulled out of default, but you're still going to have all the late payments showing on your credit report. And a brand new loan will be created for you. That's going to start off, let's say you did a rehabilitation in April with your first new payment after your repayment plan starting in May. What they're going to do is they're going to create a brand new student loan on your credit report that looks like it's opened in May, where you're starting fresh, day one with positive payment history, but you'll see old negative student loans that are closed on your credit report from the prior defaulted loans. So as far as credit goes, one other thing I will mention when it comes to student loans and credit reporting, the payment history that you're building from student loans is helpful for your credit score. Paying off your student loans quickly isn't going to positively influence your credit score. It's not going to hurt your credit score, don't get me wrong, but it's not like if you pay a loan more aggressively, you'll see an increase in your credit score. Really, where the loan is helping you is by providing a mixture of a different type of account, right? It's an installment account. If you had only credit cards, you wouldn't have as strong of a credit mix. With having installment like a student loan and having things like a credit card, you are now positively influencing the credit mix section of your credit report, which is about 15% of your credit score. And it shows creditors you have the ability to pay different types of debt on time. It also influences payment history, which is 35% of your score. So that's the biggest factor. And then when it comes to the utilization ratio, that's 30% of your score. A lot of people think things like credit cards or not credit cards, things like student loans or auto loans impact that section of your credit report, but they do not. Only lines of credit like credit cards impact the utilization ratio. So paying off a student loan quickly will not have any impact on utilization ratio when it comes to your credit report. So I'll pause there. Any questions at all on credit cards, on student loans and credit reporting? All right. So if you are wondering how to determine eligibility for these different repayment options, you are able to go online to studentaid.gov/loan simulator, and you're able to log in and it'll link directly to any open student loans you have. or you can use it as a guest and you can plug in the information manually, and then you can take a look at all of the different repayment options you have eligible or you have available, and if you are eligible for any of the income-based programs. And if you're looking for assistance to find out whether you are eligible for any of the forgiveness options, we do have a resource that I have here on the second bullet point. So we have a website. You can reach out to me or ask me in chat, and I'm happy to send a clickable link for you there too. That will also help you with the rehabilitation process as well if you have defaulted student loans and you need to pull them back into a current status. So those are all the prepared remarks I have here for today. But does anybody have any questions on student loans or credit?
I have a quick question, Ivory.
Yes.
If, and I'm pretty sure I know the answer, but I just want to make sure, if somebody doesn't have any other established credit, they just have student loans, since it's reporting the trade line to their credit report, even though they're not making payments, does it help their credit score? Like if they're in deferment and they have a loan reporting?
Yeah, it still will have some positive impact on credit score. It's, it's best to have multiple types of credit available, because you're going to be pretty limited in the score you're going to have if you only have the student loans, just because it's in the deferment status. So it'll help with payment history a little bit, but it's not going to be like a credit card where if you have a zero balance, it still reports as like a positive on-time payment every single month.
Right.
It's just
but if it's the only credit line they have, like say it's somebody who doesn't have any other debt, they have no credit score. If they have just a student loan, does that generate a FICO if they don't have a payment history?
If they only have one student loan on their credit report and that's it, it's not going to generate a FICO, because you would need 3 open active trade lines.
Okay.
So
cool.
Yeah, so that'll inhibit them. Yeah.
Okay, cool. Thank you.
Yeah. I think that is the only question that we had. So with that, I will let you get back to the rest of your day, but thank you for joining me today. And then Melinda, I'll send you the link here I'll shoot it to you via email. That way you can reference the email.
Perfect. Ivory, can I pick your brain when this
Thanks,
is all
Ivory.
over?
Yes, of course. Bye, Debbie.
Bye.
Go for it, Misty.
So I had a client try to co-sign for his son